Now let's talk about the public fade, or the fading of the public. If you had any doubts that the retail or public trader is faded by operators with consistent stop hunts, then what you're about to see right now may change your opinion just a little bit. Um, where you see our yellow vertical lines, this indicates on our MFI indicator where the public entered the market. And I think I've marked here just the last 9 that occurred on the public bars. And when we look at each line, we can see that most of the time that price reversed when the public went in. And there are 2 times on here that did not occur, and I'll tell you why in just 1 minute. I mean, for instance, let's look at this bar. This is a public bar, and immediately on the next bar, price turned around and started to go up. This is a public bar. It went up, and immediately on the next bar, price started to turn. And as you notice that it will turn and usually go back to test the entire length of the public or retail bar, because this is the herd. This is where the herd is located, and wherever you have prey, you have predator. And let's look at this one. The public went short here. Price immediately on the next bar starts to turn and go back up. The public went short here. Same thing. Next bar immediately returning. Public went long here. Next bar immediately starts to turn. Public went long here. Next bar immediately starts to turn. Now there are situations where the public is not faded, and that usually comes on a breakout. For instance, this is a low here, so this is support. This is support for the down move. But now this bar, this public bar, is a breakout bar, and on a breakout bar, the public is usually not faded until after 1 more bar. So we have a breakout bar here. Then this next bar, the public wasn't faded too much yet, although we can see that it's starting to become under accumulation here. So the insiders are buying in here. And this arrow here, it shows a breakout. This was a prior high here, because we had a down bar after a series of up, so that makes this a high once we have a down bar. And this public bar is the breakout bar, and the public was not faded here until the bar after the breakout bar. And that's because on breakouts, too many new traders are entering the market at one time. It's like a stampede. It's a herd. So the operators, they don't have enough time to make plans for all of this order flow at one time. And see, that's where their advantage comes in, because they know the order flow on both sides of the market, so they can plan their strategy accordingly to take the market up or down, to take out the public. But when that stampede occurs, they know they need to stand out of the way, because they can't foresee exactly what's going to happen next. They don't know when all these new people are going to stop piling into the market, so they will stand aside for a bar. But we'll be talking more about the fading of the public later as we go along, and how we incorporate it into your trading. But just as a quickie, when you see a public bar, the bar closes and it's a public bar. If you're in the market, you may want to get out. For instance, here, if you're short here, you're in the market and you see that this bar closed and it was a public bar, you need to think that maybe I need to get out, because the public is going to get faded. And so for instance, if you were long here when the market closed here, as a public bar had closed up, you may be thinking it's time to get out. because the price is likely to reverse and at least go back and test the length of the public bar. So, but we'll get more in depth about it later as we start combining these concepts, and that's going to be all for now on the fading of the public. Now let's talk about operator power, or the power of the operators to actually move and manipulate markets. And later on we're going to be talking about how to use all of these things to our advantage in our trading. But on this chart, each green vertical line represents where operators entered the market, or operators and professionals dominated that particular bar. And let's start with this operator bar here. And the time you really want to look for operator participation is at support and at resistance, meaning at a high or at a prior low. But so now we can see here we had a low here, and this bar here was an operator bar, and it was up, and this is a bullish reversal. And if the operator is participating on the bullish reversal, then so should we. And as we can see, price did continue on up. And usually when the operators come in, and they will take price from resistance level to support level, or from support level to resistance level. So they actually provide the fuel at the bottom or the top. They provide the fuel at the bottom to take it up to the next top, or they provide the fuel at the top to bring price down to the next bottom. And the decisions are made at support and resistance, at a prior high and at a prior low. And as we look at each of the operator bars here, we can see that price usually continues in the direction of operator participation for at least 1 or 2 bars. Now the bars that I have the blue arrows by, now they designate operator bars. Now these look like down bars, right? Okay, but although these bars close down, they are strong bars. And when you see the operators show up on strength, then that tells you that the market is not weak, that the market is actually strong. And these 2 bars here, they show that fact, because operators showed up on this bar. This was a down bar, but it was a weak bar. You only want to trade down on weakness, and this is not a weak bar, it's a strong bar. You want to go long on strength. This is actually a strong bar, it is not a weak bar, and you actually want to go long on strength and not short. And once again, once we get into how to determine strength and weakness by using our price volume spread, these things will become a lot more clear. But and I'm sure you're going to look back on your charts and notice what happens when operators enter the market. And when the operators enter the market, if we're against them, we want to switch and get on their side. I mean, if you're short here and you see this strong bar with operator participation, you want to get out of that short and consider going long. Same here. If you're short here, you want to get out of that short and consider going long. Or if you're not in the market and you're looking for an opportunity and you see this down bar, don't think short here, because this is a strong bar. Think long. Don't think short here. But that gives you the general idea. I just wanted you to see a little bit of the operator power in action as it is displayed on the chart. And most everything that we talk about, I will be proving to you on the charts so that you can see it yourself. So the main thing to remember is that we want to pay close attention to operator bars at support and resistance, meaning at a reversal at support or resistance, or a breakout at support or resistance. Because if they're in on the breakout, then that breakout is 9 times out of 10 going to continue. If they're in on a breakdown, then that breakdown is usually going to continue. But that's all for now on operator power. I think you get the idea.